Price moves down, but it does not accelerate. The session forms inside previous pressure. April 22nd Asia session forms near the midpoint of April 21st U.S. session box. It stays there. It compresses. It does not expand. Price tries to lift. Distance is short. It gets pushed back quickly. You see it. Up moves are weak. Down moves come faster. This is not balance. This is pressure building. Then the price drops. It breaks below April 22nd U.S. session lower boundary. No hesitation. No pause. That matters. If price leaves a boundary cleanly, it does not come back immediately. Here, it continues. Price drops again. Breaks below February 2nd U.S. session lower boundary. Still no hesitation. Distance increases. Pullbacks are shallow. This is continuation. But even here, you check again. Does it slow? Does it hesitate? Not yet. Price continues. Reaches April 17th U.S. session upper boundary. Now it pauses. This is where structure meets structure. It touches. It stops. It compresses. You feel the shift. Downside was clean. Now it hesitates. This is where execution matters. First, this is not a new trade. April 22nd U.S. session already formed a short entry at February 2nd U.S. session 1.5x extension. That position is still active. So this move down is not entry. It is exit. April 22nd Asia session is where that short gets closed because price reached April 17th U.S. session upper boundary. It paused. It compressed. Downside no longer accelerates. That is enough. You exit. Not because reversal is confirmed, but because continuation stopped. Now assume you did not have that short. Now you must decide again. April 22nd Asia session. Price already broke. April 22nd U.S. session lower boundary. It returned slightly. It hesitated. This is where most fail, because they try to chase. But structure is already extended. You do not chase extension. You wait for return. Price comes back to April 22nd Asia session box lower boundary. It touches. It pauses. It tries to move up. But distance is short. It cannot stay above. This is the signal. Short at April 22nd Asia session lower boundary because price returned to boundary and failed to hold above it. Stop sits above April 22nd Asia session upper boundary because if price moves there, this failure has turned into acceptance. Target sits at February 2nd U.S. session lower boundary because that is where price already broke and where continuation completes. Risk-reward ratio 2.85. Now the critical mistake. Some place stop at midpoint. April 22nd Asia session midpoint. That feels logical. But look at structure. The box is compressed. Midpoint is too close. Too thin. Price does not need to reverse to hit that level. It only needs noise. Small pullback, normal fluctuation, and you are out. Even if direction is correct. This is the trap. You are right, but positioned wrong, because your stop does not represent failure. It represents discomfort. So rule becomes clear. If session is compressed, midpoint is not a boundary. It is noise. You avoid it. You use full boundary. Only there does structure actually fail. Price moves down. At first, clean, then slower, then stalls. Distance reduces, reactions increase. You feel it again. Continuation is ending. And that is enough. Price moves up, but it cannot stay. The session forms inside lower memory. April 23rd U.S. session forms inside the lower half of February 2nd U.S. session box. It compresses there. It holds. Then price lifts. It breaks above April 22nd U.S. session lower boundary. It continues. Reaches April 22nd U.S. session midpoint. Then stops. This is the decision. If price is strong, it continues above midpoint. But it does not. It pauses. It compresses. Distance shrinks. Then it drops. Back inside April 23rd U.S. session box. That matters. Because breakout failed. Now execution forms. First scenario. Long at February 2nd U.S. session lower boundary. Because price reached the level. It held. It moved away. Stop sits below April 17th U.S. session upper boundary. Because if price reaches there, this holding has failed. Target sits at April 22nd U.S. session midpoint. Because that is where price already failed once. Risk-reward ratio, 3.8. Price moves up. It reaches target zone, then slows. This is where most hold. But structure already told you. Midpoint is resistance, not continuation. So you exit, not at top, but at failure zone. Second scenario. Price reaches April 22nd U.S. session lower boundary again. But now from below. It touches. It pauses. It tries to go above, but cannot stay. This is the shift. Same level. Different behavior. Before, it broke above. Now, it cannot hold above. That is enough. Short at April 22nd U.S. session lower boundary. Because price failed to stay above it. Stop sits above April 22nd U.S. session upper boundary. Because if price moves there, this failure becomes expansion. Target sits at April 17th U.S. session upper boundary. Because that is where downside previously paused. Risk-reward ratio, 1.52. Price drops, but not clean. Moves stall. Reactions increase. You feel it. This is not strong trend. This is rotation. If downside was strong, it would accelerate. Here, it hesitates. So you manage. You do not expect extension. You expect return. Now everything becomes clear. April 22nd showed clean failure and continuation. April 23rd shows mixed structure. Both sides fail. Nothing holds. That is the environment. You are not predicting direction. You are watching behavior. If price cannot stay above April 22nd U.S. midpoint, it returns. If price cannot stay below February 2nd lower boundary, it returns. If both fail, you reduce expectation. Entry is not guess. Stop is not fear. Target is not hope. Everything comes from one question. Can price stay or not? And across April 22nd and April 23rd, it keeps failing to stay.